Welcome to the Markets in 3. My name is John, Senior Market Analyst here at Anzo Capital. Today, I'm going to be taking you through 3 important market moving things that I feel is important to the markets right now, and hopefully you get to learn something on the way. So today, we're going to be talking about potentially going long on US dollar Swiss, where I'm looking to do that and why I'm looking to do that. There are some elements that we need to bring into this because the market has just continued to run on. The next thing I want to talk about is the Australian CPI coming up tomorrow. Inflation data is always important to markets, and especially in this day and age where we are seeing oil supply shocks and we are seeing inflation play a big role in what central banks are looking to do on a interest rate point of view. And then we're going to be talking about the final thing. The skill of the day is going to be about why traders shouldn't just use the US dollar index when they are trading gold. Very, very common practice to see people online saying that you should watch the US dollar index and then put your gold chart next to it. And that's not necessarily always the case. It can be a good starting point, but you should look at some other things instead. So let's get straight into it. My name is John, like I said. Let's go into the chart check. So dollar Swiss, why am I interested in dollar Swiss? Well, if we look at it from a technical perspective first, we can see that the price has been breaking out and forming higher highs and higher lows. We can see that we've recently traded out of the 0.8 handle, breaking out of these previous swing highs. So from a technical perspective, the market is now making higher highs and higher lows. We can also see that we're trading above the daily 50 moving average here, which is a good sort of kind of mark that we are seeing an extension of bullish momentum to the upside. And kind of like a rule of thumb that I like to go by is that if we're trading above the 50 moving average, we want to be bullish. If we're trading below it, we want to be bearish. Now, obviously, there are other context and information that you need to bring into that, but it's just a good rule of thumb. Now, looking at current dollar Swiss price, we can see market has already rallied. So where are we going to be looking to be a buyer? Because we definitely don't want to be buying now. Why? Because we're up against this weekly resistance level of the 0.81 handle. And if we were looking at it from a terms of like reward to risk ratios, it doesn't make sense to go long there, right? Because if that is our initial target or a level of potential target, then this is an area where sellers might enter the market. So I don't necessarily want to be buying in this area here. So when I'm always looking to plan a trade out, I always like to say to myself, where am I going to get the most for my money? Where am I going to get the most from the capital that I'm going to put at risk? Now, the best level possible is back down at previous swing lows. Why is that? It's because I can have a tighter stop loss and I can have a higher return to my risks. So the most ideal place is for price to come down to this 79.25 handle, where I could potentially look to go long back up towards that 81. However, what is the likelihood of that? Not likely. So the next thing I like to look for is other areas of support and resistance. You can see this strong level at 0.8. You can see it acted as resistance here and here. Could that now turn into an area of support? So what I like to look for as well is if price can come back down into these previous structure areas, can we get a bit of a change in time, structure on our lower time frames, and can we look to get involved in and around that area? So from a technical perspective, we're approaching this resistance level, but we've also got this key strong support down at that 0.8 handle. You can see we've also got a nice little trend line here acting as support too, but I don't play too much into mind to that. What I'm really looking for is, can we get a pullback in this market? And does that pullback reach a strong level of support? Plus, does it continue and start giving us the right sort of information to go to the upside? Now, why am I interested in this? Well, when I look at the currency strength meter here, it can tell us a few things. Now, this is something that I built myself. This is just giving me a little bit of an insight into what the currencies are doing and where I can best position myself, where I want to position myself with a strong currency versus a weak currency. Now, if we just take a quick look at this current strength table here, it tells me that the Swiss franc is one of the weaker currencies, and the US dollar is one of the strongest. So immediately, I want to be bullish on this pair here. Now, if we go down to our trade signals area here, we can see that dollar Swiss also matches on this level. When I look at the historical strength meter, and I highlight the US dollar and the Swiss franc, we can see that over a period of time, the US dollar, which is the yellow line, has been getting stronger, whereas the Swiss franc has kind of mellowed around the middle, has showed a slight sign of strength, but has now completely reversed that and is one of the weakest currencies at the moment. Now, that actually showed that that was forming around about the 6th of June, or the week starting the 6th of June. Now, if we have a little look back at when that particularly was, it was the week starting here, this Monday, right? So what happened there was the market rallied, found resistance at previous structure highs. Remember, look left. You want to always look left to see clues. Market comes back down. Where does it find support? Previous structure highs. Market then rallies to the upside. This move here was obviously thanks to a really hawkish Federal Reserve, and the market has pushed higher. But that is the blueprint of what we're looking for. We're looking for a strong currency against a weak currency. We're looking for the conditions to then tell us that, yes, we are seeing markets make higher highs and higher lows, and then we want to buy the higher low in order to be, try and look for a profitable position. The way that you can do that, or the way that I like to do that, is look at lower time frame changes in trend. So you can see here the market is clearly making lower lows and lower highs. We get a little bit of a inverse head and shoulders pattern being built, and then the market rallies, closes above the 50 moving average. This was the FOMC news here, but that would have been a really good time to enter dollar Swiss, stop loss below the low, target up towards that 8100 area in here. And you can see markets trying to break out yet again, because the dollar is a stronger currency at the moment. Now, only time will tell if that remains to be the case, because obviously, we've seen a hawkish Federal Reserve, and that has been reflected in the US bond yields as well. So one thing that I'm really watching at the moment is the US 2-year bond yields, to see whether this dollar strength is going to continue or not. Now, why am I bothered about this market in particular? Well, bond markets are forward-looking markets, essentially. They are trying to predict what the Federal Reserve are going to do next. Now, if I just show you with a quick comparison, and I just get the US interest rates on here on a new price scale, just go up to a weekly chart, and let me just turn this into a line chart as well. I'm just going to zoom out. So you can see here that often bonds will lead the interest rate decision by the Federal Reserve. Okay, so you can see that we've broken out down in 2022. Bond yields started to go on a significant rally because markets expected interest rates to go up because inflation was also going up. Okay, what do we have here? Well, bonds started to go a little bit early. You could see around about sort of July, August, bond yields started to rise. And then it took until early 2022 for the Federal Reserve to actually start hiking interest rates. Now we've got a similar thing now. We are trading above where current interest rate levels are, which can lead to a potential rate hike. And we saw that with the recent decision by the Federal Reserve, where we saw the dot plot showing that actually the chances of a rate cut coming at all are now pretty much gone. Now, there are a few caveats to this. For one, inflation has to be persistent. Okay, we have to see persistent rises in inflation. How do I find that out? I hear you say. Easiest way to do that is go to tradingeconomics.com. And what you can do is look at some things. So the first thing, you've got the US 10-year, which is something that we look at as well. I was just showing you the 2-year. The 10-year is just a different maturity of the bond. It's just a longer maturity. But you can look at things called TIPS, right? So this is the 10-year TIPS, and that basically is inflation protected securities. Okay, so what this is showing us is including inflation where they expect the interest rates to kind of be at. So at the moment, that is not too out of control. We have seen obviously a continuation of that move to the upside there, but there are other factors we can come into this. So if we're looking at the US market, so if we go to indicators, we can come here into inflation rate. And we can look via country, okay, where we look for the higher interest rates. And what we need to look for is the United States. And you can see that the United States at the moment is seeing that kind of continuation of inflation. It's the average is tracking higher, right? You can see from February, we've gone 3.3, 3.8, 4.2. And if we come down to core inflation rate, you can see that that is also climbing as well. So what we need to see from this is a higher persistent inflation. So if I just roll out to 10 years, you can see here that in 2001, 2022, we started to see that persistent gain in inflation, which then bond yields then tracked higher, which then meant that the Federal Reserve hiked interest rates. Obviously, recently that has been declining, but now we're starting to see a pickup. So if we start to see kind of core inflation rate heading above 3%, heading higher than 4, maybe even 5%, then the markets will really be pricing in more hikes by the Federal Reserve, and that can produce a stronger US dollar. So that's why I like the idea of being long US dollar Swiss at the moment, but we have to be aware that we have to keep an eye on our bond market just to give us that extra confirmation that we are going to see the US dollar continue to strengthen and move forward. So, like I said, if I'm going to get long, I need to wait for a pullback now. I want to see some kind of like lower lows and lower highs coming in. And if I do get that on a lower time frame, I'll look for that to break. Try and target this 8100 level again. If that breaks, I can look for continuation longs. So let's move on. Let's move on to the big story. So what is the big story in the market at the moment? Obviously, I'm not going to talk about the geopolitical tension that's going on, but one of the big stories coming up is tomorrow. So tomorrow we actually have some really, really important data. If I just actually go over to this one here, we've got the Australian CPI, and that is the inflation rate in Australia. Why is this important? Well, the RBA have been one of the only central banks to be hiking rates recently. Okay, they paused their previous meeting and basically were a little bit more dovish in their tone, saying that they think that they've tightened enough for the current conditions. However, that rhetoric has recently switched again, and we've started to see the RBA governor talking about hiking interest rates. Needs to be backed up. That's what the data is. The data kind of backs up or cements those words, right? Those expectations from traders. So if I just actually quickly pop down to this area here, interest rate tracker, we can have a little look at some things. So the RBA at the moment, okay, is 23.9% probability of a hike, and they've been a little bit more hawkish. So the likelihood is that we are going to see a little bit more of a hold from the RBA in the upcoming meeting, but that's why this inflation data is so important. If we see inflation rate year on year forecast at 4.4%, if it goes above 4.4% or even towards the max side of 4.9%, then the RBA is more likely to hike interest rates because interest rates aren't high enough to control the rate of inflation. So that is one of the tools that they can use is by hiking interest rates. So if that was to happen, then we could see something potentially there. The other one that you need to watch out for as well is the RBA trimmed mean CPI. Trimmed basically means that it is core CPI, right? So it takes out those more volatile elements of the CPI report, so fuel and all that kind of stuff. So that is a number that I also want to keep an eye on. So if we see an increase here from 3.5%, maybe 3.6, 3.7%, a jump up as well in the inflation rate here, then that is going to be a very interesting time for the Australian dollar. And I do think that on that information, the Australian dollar could be a little bit more bullish. At the moment, on the currency strength meter, Aussie is the third strongest currency at the moment. It has been getting stronger, but you only really want to be trading that against the Swiss franc, potentially against the New Zealand dollar. If we go take a quick look at those, if we look at Aussie Kiwi, we can see we're starting to break out of those recent swing highs there. So there might be an opportunity to be another buyer of Aussie Kiwi. And the other one was Aussie Swiss, where we can see that actually we're starting to see a little bit of a down day in the Australian dollar. And likelihood of that is because we're seeing a lot of risk off in the markets at the moment. S&P 500 falling and all that kind of good stuff. So keep an eye on your Australian dollar coming into tomorrow, because that event's going to be overnight. So I wanted to make that very clear. But if we do see a rhetoric where we see a shift to a little bit more of a hawkish tone from the central bank, or obviously that inflation data comes out stronger, then you want to be looking to potentially buy that currency against weaker ones like the Kiwi, like the Swiss franc. Let's move on then. So the final part of the market sim free today is the skill of the day. And I want to be talking here about one or two things. Now, what most traders do when they trade gold is they look at the dollar index and think, yes, dollar is getting stronger. I want to be buying gold, selling gold, sorry. And that is part of the story, right? Because if the dollar is stronger, gold is priced in dollars. So you expect that gold prices will fall. But it's not always the case, because the dollar could be strong for a multitude of reasons. The dollar can be strong because it's a safe haven. It could be stronger because of economic data. It could be stronger because of a multitude of things. So you can't just rely on the dollar index. And to prove that, if I just add the gold chart on here, you'll see that sometimes they correlate with each other, right? So let's take this area here, for instance. Let me delete the drawing tools. I'm just going to put a line chart on. Let me get rid of that 50 moving average in there as well. Okay. So what are we looking at? So the dollar index is the yellow, right? And the blue line is gold. Now, from here onwards, there's a correlation. Dollar's getting stronger, gold's getting weaker, right? Very strong correlation. However, through this period here, because they should have an inverse relationship, right? You can see that they follow each other here as well. You see that they follow each other. The price of gold is rising as well as the US dollar index, right? So if you're solely focusing on the US dollar index to trade gold, you can see it has flaws already, right? You can see that actually they're moving in correlation here. They're moving in correlation here. This is perfect environment, because dollar index should be inverse of gold. So when it does do that, it means that everything's lining up perfectly and you've got that correlation there. So just be careful that you should not use this particularly all the time to trade gold. However, there is another asset that you can use, right? So if I add on here bond yields, okay, so if you search USO2Y on your trading view terminal, click new price scale here, you can see that the US bond yields have a strong negative correlation with gold, okay? And even, let me see if I can just take off. Let me see if I can just hide the dollar. Here we go. So even here, look, bond yields start to rise in March, okay? I'm going to take this off. Pretty much straight line. So even when the dollar had a little bit of a fall through this period before, bond yields still remained very bullish. Look what happened to gold. Boom. Complete inverse of that, okay? And yes, there are times where they can correlate a little bit, but you'll find that it's less likely. Look at this area here where we see bond yields driving lower. Look at gold there. Nice rally. So the cleaner way to look at gold is by looking at bond yields, okay? And the reason is because yields offer yield. Gold does not offer any yields. So what investors are doing constantly is looking for that yield, right? And obviously gold has exploded over the past couple of years. So they're looking to take those profits from gold and they're looking to put it into somewhere. Now, if bond yields are rising, that means that they are going to get more for their money. So if they were to invest it into 2-year yields, for instance, they're going to get a certain percentage back per year for holding their capital with government bonds, okay? So just a quick one. When you are looking at gold to trade on a daily basis, keep an eye on your US 2-year yields, your 10-year yields, keep an eye on that more often than the US dollar index. You got to remember the dollar index is a basket of currencies against it, and it's actually more heavily weighted to the euro. So if you're going to use anything, dollar index, euro, pretty much the same thing. So I'm going to leave it there. Thank you for joining me for the markets in 3 today. Hope you enjoyed it. We discussed a US dollar Swiss long idea for the chart check. For the big story, we talked about upcoming inflation data in Australia. And the skill of the day is don't just rely on the US dollar index when trading gold. Thanks for watching. So hope to speak to you soon.
On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.